Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Dave Aspell from Mount Lucas Capital, welcome to the show. Good to have you here.
Thank you very much. Pleasure to be here.
Lovely to see you, Dave.
Let's jump straight into it. Actually, we were recommended to speak to you by our mutual friend, Linus, who we've had on the show, who runs a great database. Where did you meet Linus?
I met him. We overlapped at Man Group in New York in, I think, the late 2008 through 2010. I think he was at Man at the same time that I was.
Interesting times they were. Well, yeah, give us a bit of a background, Dave. How did you get into trading specifically? Like, what's your journey been in trading and funds management? And then perhaps give us a bit of a history of Mount Lucas, because there's quite an extensive track record for the firm. So what are the origin stories there?
Yeah, I'll do my one in 3 seconds because mine's not super interesting. I started at Man Group in 2004. They ran AHL, obviously, and at the time they had some fund of funds businesses as well, and they were trying to invest in other managers as well for diversification to run a bigger product. Which is where I met Linus. He was covering CTAs and managed futures folk there. So I was there in London from 2004 through 2008, and then I got a chance to move to New York, and I moved literally 3 days after Lehman Brothers failed, which was not great timing. And so I was in New York for 6 months, and they said at the time, you can stay in New York. We need you to go to Chicago, where Man had another business. So I moved from New York to Chicago. Wonderful town, just fantastic place. So I was in Chicago for a further 2 years, and then Man was invested with Mount Lucas at the time. And I spoke to Tim Rutterow a lot, who's the co-CIO, and he was a CIO at the time, the founder of Mount Lucas. And I was speaking to him a lot, and I got the chance to come and do risk management for him at Mount Lucas, which is in rural Pennsylvania or semi-rural Pennsylvania, or about a half hour north of Philadelphia. And I jumped at it. He's a fantastic guy. They've been around a really long time. The origin story for them is real interesting. That they came out of the founder of Mount Lucas was the founder of Commodities Corp back in I think 1969. That was Frank Vanneson. He was at Nabisco with Helmut Weimar in the late 60s, and they, after trading successfully for Nabisco, they span out to start Commodities Corp, which was around. I think they started Commodities Corp in 1969. That was around till the mid-90s. Tim Rutterow, he joined, as he never fails to remind me, has been trading soybeans longer than I've been alive. He joined them in 1979 and worked for Frank. And then in the mid-80s, they span out, I think I did have some notes here, but in the mid-80s, I think 1986, they span out of Commodities Corp with in an amicable split because they wanted to run money for the Eastman Kodak pension plan. Rusty Olson was like a pioneer in that space. He started, I think, running the Eastman Kodak pension plan in the early 70s and ran it for some 30 years. And in the mid-80s, he was looking for diversifying assets to their traditional asset allocation mix and came across Commodities Corp, wanted to invest in these newfangled CTA managed futures commodity guys. But Commodities Corp was, the Eastman Kodak plan required, was an ERISA plan. You needed to be registered. Commodities Corp wasn't registered, so they decided to spin out and run money institutionally. So in the mid-80s, Frank and Tim span out of Commodities Corp, started Mount Lucas. Commodities Corp was in an old farmhouse in Princeton, New Jersey. and it's on the corner of Mount Lucas Road and Poor Farm Road.
Right.
If you're spinning out, and if you're going to start a money management business, don't call it Poor Farm.
No.
So they went with the other one.
Choose the other.
Right, they use the other one. So Mount Lucas was in the middle of Princeton for a long time, and then in 2009, I think, moved just over the river. Tim had a farm in Pennsylvania, and so then they moved over the river into Newtown, Pennsylvania, which is where we are now. We've been here for, I think, 15 or 16 years. And their origin story from that point was Rusty Olson invested with them, and I think in 1986, and when the crash of 1987 came along, obviously the equity market plummeted, and Tim and Frank did really well. They were trading an active managed futures strategy, did really well, and then Rusty Olson comes along for the manager meeting in the first quarter of 1988 and says, you guys did fantastically well, and asked two questions, which are sort of the genesis of how we view things now, which is what's the win behind the sales in managed futures? Like, why do you make money? And what's the benchmark for it? At the time, he said, I know how to benchmark an equity guy. There are equity indices. It's an easy thing to do. I can benchmark a bond guy. What I don't really know how to do is benchmark some long short commodity guys. And at the time, for them, they were an absolute return trading shop, and for them it was easy. You either made money or you didn't. But what he wanted was a benchmark, and so they said, Tim goes to the dictionary, goes to B, tries to find out what the word benchmark means. This was a long time ago, and says, I'm not sure in particular what a benchmark should be, but we think we should be able to. What we're doing, it needs to be a long short benchmark, and these are the things we trade. We think we should be able to outperform a 1 year moving average on the long side and the short side. That sounds like a benchmark. They did outperform it. And then over time, he says, you know what? That sounds like a pretty good, this benchmark's an interesting return stream by itself. Is it investable? And they're like, yeah, sure, why not? It's an easy thing to do. So they built in 1988 the MLM index. It's largely the same. It's added some markets over time. It's changed a little, but broadly, it's the same. It's the same type of model. The DNA of it is the same. We've been running that ever since.
And Dave, just quickly on that, the MLM index, effectively a moving average trend following model, long and short?
Yep, that's exactly right. Yep, 22 futures markets, long and short, 1 year moving average. If you're above the moving average, you're long. If you're below the moving average, you're short. Rebalance. That's it. It's what I think now is called pure trend following. It's what we've always done, and we think it's a beta like other betas are, and it should be accessed in a similar way. So they run that. We still run that now. We run it at different levels of volatility. Some people have got different quirks. Some people have got quirks around equities or not. Some people have different cash management things. Some people like to run it at higher vol, at lower vol. These are all pretty easy things for us to do. So we do. And then in the mid 90s, Tim and Frank had done real well. And then for their own personal capital, they teamed up with an equity guy, Roger Alkali, who'd been around, who was did M&A and merger arb in the 80s, and they teamed up with him as the equity guy, and Paul DeRosa, who ran prop bonds for Citi for a while and was at the Fed, I think, in the 60s and 70s, had a primary dealer. And they said, well, we're commodity quants. You're an equity guy. You're a bond guy. That sounds like a macro hedge fund. How about we just pool our money and we'll keep running the MLM index and we'll run a macro hedge fund. So that's been running as well since 96. So it's a 27 year track record. And the DNA is largely the same in that strategy, which is that we think that managed futures are a fabulous way to diversify equities. So we put equities with managed futures together, add on some keep that as a core portfolio, add on some discretionary trading as well, where generally we're what I'd call old school macro traders, which are sort of a bit of a dying breed. But when the DNA of the firm comes out of the 70s and commodity traders, where they saw soybeans go from up by 500% and the oil price double overnight, they've got a right skew kind of risk preference. So the old school macro is very directional in nature. have a view of the world, and then compare it to market prices, risk a certain amount of AUM on an option-like strategy or an option-like structure, and sit and wait. A few large themes, accept the volatility, don't optimize, be robust, don't sell vol, be liquid. Don't vol target.
You jumped onto this. You jumped onto this material allocation across those three areas: equities, bonds, managed futures. Well before a lot of the research papers were coming out in the last few years, saying about the breakdown in the bond and equity relationship, and the need to have a material allocation to managed futures. What you're saying is that your firm, right from the outset, decades ago. Were placed heavily in this sort of material allocation across these different asset groupings.
Oh, that's exactly right. The macro hedge fund, the whole point of it was to say, if I got hit by a bust tomorrow, how would you want your wife to invest for the next 30 years? And they said, well, we want to own the equity risk premium because, we want to benefit in the wonderful thing that is capitalism and the growth of the economy. And the best way to do that is to buy the equity risk premium. But you go through periods where equities aren't great, and you need something that diversifies it. Fixed income is a way to diversify, but as you've just seen, sometimes bonds go down. Who knew? They thought a better way to diversify was long short. Was the MLM index was long short, managed futures trading across asset classes. So they put those together, and the MLM index piece is fixed income, currencies, and commodities, and that's it. That's the genesis of the business. And you're right. To us, it just seems like a much better diversifier than, or at least it's an essential piece of a diversified portfolio. Futures allow you to lever things somewhat. So we think it's a great core macro portfolio. And then within the equity side, we thought rather than buying just the S&P 500, what do we know? We'll have a read of the academic literature, see how we can. If we think you can outperform equities. So we do a few different things there, buy some value, buy some growth, buy low vol, put them together and run that alongside the MLM index. At its root, we think that managed futures is an element to a portfolio. And that part runs through everything that we do. And I think it's kind of important because I feel like a lot of people in the managed futures space now, they view it as, or they build things as if they're a standalone investment, which is a fine thing to do. I mean, I like trend following way more than the next guy, and I'm not knocking it. It's a great thing to do. But we've always viewed it as a portfolio element, and if you view it as a portfolio element, then some of the decisions that you make along the way, we think, alter. And what we try and do is essentially we're skew maximizers. Again, this is the whole commodities core thing. They're very, very accepting of right tail risk, and so what we try and do is just make the decision at every decision point to maximize skew at the expense of Sharpe ratio, because in a portfolio context, when you rebalance things, we think that makes most sense.
So you're the positive skew guys when it comes to
that's what that's kind of how we try and do it. I mean, there's a few ways. I mean, am I right just carrying on talking? Is this
no, Dave? I just wanted to say something quickly here, Dave.
Yeah, go for it.
What's interesting to me is that with this the traditional 60-40 portfolio, that all of the institutions and wealth managers' eyes have been on that combination for the last few decades. Now they're finding that the correlations are breaking down. They're now both positively correlated in the last couple of years. And now they're saying, but then there's a material allocation to managed futures that gives you all of this bonanza. But the thing is, what a lot of people don't realize is that when you do the research, it isn't a new phenomenon. This has been a historical phenomenon that has existed, I don't know, over 25, 30 years. It's been a persistent relationship where it's outperformed the 60-40 portfolio when you have this material combination of managed futures or trend into that portfolio. So it's just very interesting to me, and I can totally understand why. So you're viewing this world as a portfolio world. You do like trend, you do like macro, you like equities, bonds, whatever. What you're saying is that we can sort of bring this all together, all weather portfolio, effectively by merging these three concepts together. Is that effectively what you're saying here?
Yeah, that's pretty much it. Yeah. And then, so we run for institutions, generally what we run for managed futures is generally some people, they've already got stocks and private credit and private equity and those things. And a lot of people don't necessarily want our equities. They just want the portfolio element of skew maximizing managed futures. And so that's what we do for a lot of people. And if some people want stocks as well, sure, we can do stocks. But yeah, we view it as generally our clients have, it's one reason why in the MLM index we don't trade equities, generally because most of the clients that use us, they're generally looking for diversification, and particularly diversification when they really need it. It's not just this, stocks are up 1% this month, what does this do? Over boring times, is it uncorrelated? In our mind, what they want is they want diversification and something that's uncorrelated, and particularly is really helpful when you really need it. So just one of the ways we do that is, by not trading equities ourselves. Our kind of view is that generally in a raging equity bull market, they don't really need me buying more stocks. And when things start to fall, you don't really need me being long of equities for the first chunk of that down move. It's not really that helpful. And to get maximum diversification, maximum skew, we do things that are, we generally do more commodities than other people for a similar reason, that commodities are generally the most inelastic of things, so they move more. So
you're not doing things like options, sort of embedding options in there for tail risk, or short vol. You're looking at the combination of the commodities with the equities long, with the bonds long, and how they all work together.
So for the MLM index, how we do it in that main way is we trade currencies, fixed income and commodities, long, short. We get approximately the same amount of risk allocation from each of those, which means we trade a bit less commodities, a bit more bonds, and FX somewhere in the middle, because commodities are way more volatile. And generally, relative to other people, we do a few things differently. The first one, we're generally at the slower end of things. Over time, we think that has, at least our research, I think it's generally pretty well accepted that generally slower trend following has been better, at least the way we do it. That's how we see it. So we do that. We're slower. We think in times when you really need it, slower is better. We don't volatility target the positions, which is again another skew.
Thank you, Dave. Good to hear.
Yeah, it's a skew maximizer thing. Like at every juncture, which is the answer. Like I'm not really anti vol targeting. If you're building a standalone, I'm only going to do a low risk sort of version of trend following. Vol targeting is kind of fine. Like I'm all right with it. I can do the inverse vol scaling, rolling standard deviation. Sure, it's not that I can't do it. It's more that in a portfolio context, it doesn't make a lot of sense to do it, I think. So what we're trying to do is at every point say, given that this is a portfolio element, and given that I want to maximize either the Sharpe ratio or the drawdown or something of a broader portfolio, what do I do in this portfolio element to maximize that skew? So we don't volatility target the positions, we just let them run. We generally don't trade masses and masses of markets. Again, I know there's the outlier hunting view. I quite like it, but our view is that generally in a real crisis, me allocating some money to the Swedish bond future means I've somewhat taken money away from the US bond future. And in a real crisis, you kind of want the big dogs. Again, I know there's other opinions on it, which are sort of fine, but that's how we do it. There's also some historical reasons for it. We also don't do what I think the cardinal sin of these strategies is that over times when CTAs don't do very well, they went through a period where they struggled somewhat.
The winter.
It's really tempting for people to start putting in uncorrelated strategies to trend following, which often end up doing, they take away from the pure trend approach. And when you really need it, they often don't work. There's a lot of examples where, things like commodity spreads are uncorrelated to trend, and they kind of do well, or went through a period of doing real well when trend wasn't doing well. But then when you really needed trends to do well through the Ukraine and the Ukraine war, if you're trading commodity spreads and you're, short the front, long the back, because it's makes money over time in a slow drip, drip, drip way, which can help trend get through its periods, you can get in real difficulty doing that. And what I don't want to do is dilute or trend or do something that is going to hurt you when you most need it. So we're pure trend people in that world. And again, because we think it's a portfolio element, we rebalance. We think people should, and we encourage people to rebalance like crazy. So we have quite spiky performance where we make a lot and sometimes then give some of it back because we don't vol target. But we encourage people, and we do ourselves in the macro funds. If you rebalance like crazy, then having high skew elements, you're supposed to have elements of a portfolio that run at around about equal volatility, and then pump up the vol on each of them, pump up the skew, and rebalance like crazy. So that's kind of our approach. So no vol targeting, no equity, rebalance a lot, more commodities. Commodities, and I know you guys know this, but generally, we looked at should we trade the French bond. I argued with Tim about this for years and years. As soon as the French bond contract came out, like, should you trade the French bond? Like, I don't know. Much as he surprised him because I'm English. Like, why on earth would I want to trade a French bond? But like, well, you can short them. Maybe that's okay. But is there a lot of extra diversification benefit in trading the French bond, or could I get all of that just by trading an extra unit of gilts, an extra unit of bonds, and an extra unit of treasuries? Like, there's not a lot of point, but commodities they're just more. They're way more different than each other, right? Commodities themselves is much lower level of correlation. So we think you're better off trading more commodities. Commodities are much more inelastic, and generally the volatility of them moves in direct relation to their inelasticness, if that's a word, inelasticity. Natural gas is at the end of things where it's basically an unstorable market, so it's incredibly volatile. And gold is a much more storable market, so it's way less volatile. Grains operate somewhere in the middle because you've got a cycle that's a crop harvest year. We trade a lot of grains as well, so I talk a lot of my examples are grains based. And oil is sort of somewhere in the middle because it's somewhat elastic, but less so now. But that's it, really. That's what we're doing. We're trying to do. We don't sell vol. We don't do any. The other strategy that a lot of people, well, not a lot of people, but some people wanted to get into in the CTA world was some selling volatility, and you just don't do it. It's a cliche, but there's old traders and bold traders, but there ain't old bold traders. And at some point, selling volatility whacks you.
Okay, so Dave, just to clarify, you do obviously have a commodities and futures trading fund, but you do also have a macro fund that includes the equities, bonds, and the futures. In that fund, I'm just curious, what are the allocations? What's the percentage split? And when it comes to your commodities trading, how many markets are you trading there, and how do you choose those markets? So 2 questions.
Yeah. Okay. So in the macro fund, what we're trying to do, we try and size them in equal risk, and we're aiming at least we want half of the risk of the macro fund to be discretionary trading and half to be a core portfolio that's always on. The reason for that is that sometimes on the discretionary side, you just don't have any good ideas. And you think markets are generally pretty well priced, and you don't really want to have a lot of pressure to trade something because you haven't got any risk on, because you need some risk on. So what we want is a core portfolio that's always on, and we want that to run about half the risk. So generally, we want the macro fund is a bit of I said it's old school macro. We run the macro fund at between 16 and 20 vol, which is higher than a lot now. And given we want half the risk to be from the discretionary side, half from quant, we want the quant to be around about 10 to 12% volatility. And to do that, the way we think this through is that if you think stocks are a 16 vol asset, and you want around about 8 to 10 vol from that, you need to run somewhere between 40 and 60, 70%. We trend follow it a little. We move around a little. We have a core portfolio that's always on, but roughly we run stocks about between 40 and 60, 70%. And then we want an equal amount of risk contribution from managed futures. So we run a 15 vol trend follower at around about the same level of risk, so that you get, because they're uncorrelated, you're running 50% of risk in stocks, which gives you about 10 vol, about 50% of the risk in the CTA. We do some other things in there as well, trade some yield curve and some other bits and pieces. But when you put those two together, you get a core portfolio that's around about 10 to 12 vol.
And Dave, just quickly, so
Yep.
the macro all long and the CTA both long and short.
So the macro side where we trade stocks is generally long only. It's just hard to. It's a good question actually. So generally we want to be. It's just un-American, isn't it? Short in stocks, just don't do it. It's just, I just think it's hard. I don't quite mean that. I mean, it's just hard. I think.
You're
I know some people.
Dave. The Brits
I know.
go
That's
long
why I
and
was
short.
That's why I was reticent to say it. God, I got the French jibe in there. No, I just think it's hard. It's a different skill set. You fight. It's just hard. You're swimming upriver shorting stocks. We think generally stocks go up over time. We want to participate in the wonder that is capitalism. Whether you're funding, businesses, what equity markets exist to do. There's no natural short in stocks, basically. What equity markets exist to do is to fund progress the same way. And we also trade some credit on that side. If you think in our heads, it's a similar type of thing that what these markets are generally do, what the equity market exists to do is to move capital from savers to entrepreneurs or businesses so they can expand. And it's equity markets that they exist to do. That's what an investment bank does. That's why every investment bank, they've got an M&A division that raises money, and they've got an FICC division that trades things and sheds risk. And we think that one of those is a long only market. And that extends across some credits as well. If you're a country in South America that's got, that grows a lot of soybeans, I told you I use a lot of grain analogies, that grows a lot of soybeans, and you need to get them out of the country so you can grow. You need what is basically equity capital. It comes in an EM debt form, but it's the same type of thing. You're looking for money to fund progress, and just shorting that kind of risk is just difficult.
It's difficult.
And I think the other thing is, generally when I see people shorting stocks, there's some people that can do it well, and hats off to them. But generally, alpha shorts, for want of a better phrase, seem hard. I generally see more people doing it in ETFs or indices. And what they're trying to do, I think, is what they want is a core long book with lower vol. They want equity-like returns with bond-like volatility. So they've got a core long book that they then sell stuff against. And we think what they're trying to do is reduce volatility, and that's what the CTA does. We think I'd rather have the managed futures portfolio reduce the volatility, because I think shorting stocks has got a negative expected return and managed futures has a positive expected return. And they fulfill some of the same roles in the managed futures piece, diversifies it. So that's how we view it. We think, again, what the futures markets exist for is transferring risk, right? I mean, that's why they're here. Again, it's not a great analogy, but if you're running a grain elevator, if you're a farmer in the Midwest, you're growing corn. What you don't want, you're not in the business of speculating on corn prices. You don't want to do that. Futures markets exist so you can have some certainty in what you're doing. And it's exactly the same way on the other side. If you're if you're buying a lot of corn, if you're at a business that requires it, you also face price uncertainty. And neither of you want that. Neither of you are in the business of doing that. Like if you're Starbucks, right? Starbucks, where do you think coffee is on the list of Starbucks expenses? Like, it's not very high, but it's impossible to be Starbucks without coffee, right? I mean, Starbucks pays money on rent, on people, on insurance. I remember reading they spend more on cups than they do on coffee, believe it or not. But it's impossible to be Starbucks without coffee. So they're perfectly okay and very willing to pay away a premium to hedge their coffee risk. They're not in the business of speculating on coffee prices, and coffee growers are not in the business of speculating on coffee prices. So what you need is a two-sided market. One of them gets hurt if prices go up and needs someone to take the other side. The other one gets hurt if it goes down. Like risk transfer markets like that are long-short markets. And in our mind, that's just fundamentally different. So we trade currencies, fixed income, commodities, long-short. But stocks, they're not really, no one really gets hurt when stocks go to the moon. There's not a two-sided market in them particularly in the same way. That
sounds very much like the rationale of Eric Crittenden about the commodities market. The whole basis of trend following is based on the hedging principles between producers and speculators.
That's right. I know where I got that from.
So, Dave, the second part of the question then being the number of markets in the futures side and how you choose those. Are they generally just like the most liquid US exchanges that you're trading then? If it's not a super broad universe?
So we trade the major ones. We trade, I always forget which way around this is. We trade six major currencies. We trade futures only, so we don't trade FX forwards. Again, it's kind of a historical thing. It is what it is. We trade 5 bonds. We trade the 10-year point on the curve. So we trade US, Canada, gilts, JGBs, and bunds. We trade major FX, and we trade 11 commodity markets. That's it. So it's 22 in total. And there is an index. So it's an index product, right? So there's an index. It's a little bit of a different than kind of a traditional CTA that makes choices in this way. Like there's an index committee that sits and decides these things and meets and does make changes somewhat. What we don't want to do is tinker with things. But could we trade some more? Yeah, sure, you can do. But it's not. I don't feel there's an enormous benefit to it. And when you really need it, in 2022, for example, when you really needed trend, our way did fine. We think there is a certain amount of beta in it. Now, in the macro fund, we do trade some other things. We trade a lot of grains, a lot of grain options. We trade oil, natural gas. We trade a much broader set of things with the macro fund. But for the CTA piece, we think it's a portfolio element. You just plug it in. For us, it's I almost think of it as like a level 1 and a level 2 discussion. That for the majority of people, they just need to do managed futures. They just need to get it in there. Like, it doesn't particularly matter whether you choose, any of the different CTAs out there at first. Like the first decision is just doing managed futures. Mm-hmm. And then within that, then after that, if you're building a portfolio of them, some of these quirks kind of do kick in and do matter. But broadly, we view it as a portfolio element, and we want something that is pure and robust, and where I know what it's going to do, and it's not going to do something stupid. So one reason we don't volatility target, again, it's a fine thing to do, but given if you end up having what we call like a constant target exposure, then I know how long or short bonds I'm going to be in that piece of the portfolio. Whereas if you're volatility targeting, you kind of don't. Depending on how you do it. But, if I'm pairing it in a portfolio with a bond portfolio, for example, then I know that if I'm long bonds or long something over here, I know how to size the managed futures, and it doesn't quite take all of it out, or it might not. And there might be some basis between the bonds you've got. But basically, if you're 100% long bonds on one side, then I kind of want to know, if it's a portfolio element, how long or short I'm going to be, because if bonds are going straight down, I kind of want to know that I'm going to be 100% short them. Now, what I don't want is that if bonds go down in price terms by 2 standard deviations, I don't suddenly want my trend following model to cut its position by a third. And I mean, it's a fine thing to do, vol targeting, if it's a standalone product. And I think if you're building a standalone CTA, then vol targeting is an okay thing to do, and people decide to optimize on Sharpe ratio. It's fine. It's just not quite how we view it. We view it that if it's a portfolio element, then
it's hard to optimize on Sharpe when you're focusing on positive skew, Dave.
That's right. Yeah, right. And what we're trying to do is focus on the client's Sharpe, right? If it's a portfolio element world, then I kind of think the higher skew allows clients to monetize that diversification. Whereas if you're vol targeting and have a lower skew, then the manager is kind of monetizing that benefit. And what we would rather do is provide something that gives the end user's portfolio, because in a macro fund, that's us. We want to give that the highest sort of the best expected rate of return, because stocks and credit are negatively skewed assets, right? Everyone knows this. They tick up, and then boom, it's like the Taleb thing about the life cycle of a turkey. Like, you've all seen it. It's great, and then whack. Managed futures are a positively skewed asset class. So what we're trying to do is maximize the positive skew on a managed futures side, so that when you put them together, you get a portfolio that's normally distributed. We're trying to cancel out the negative skewed nature of stocks and credits, so that your overall portfolio looks nicer. And I think of it this way: like in 2008, CTAs made a lot of money short oil. We made a lot of money short oil. But what you don't want is to be limit short oil from, I don't know, if you're a slow trend follower, maybe that was August, right? It sort of oil peaked at 145 in July, I think, roughly. Doesn't really matter which model you use. Most trend followers are short by the time Lehman goes, which is mid-September. And if you're fully short, stocks don't vol target, right? There's nobody vol targeting the S&P. And so when Lehman goes and stocks fall by 10% in 3 days, what you don't want, in our sense, if your diversifying asset is being short oil, oil's plummeting, that's great. What you don't want is oil to go down to be in a normal world going down by 2%, have an 8% down day, and then suddenly you're very large short that's helping you diversify stocks. Suddenly like, oh, well, it's kind of vol targeting. Sorry, I'm going to take that off. And suddenly I've only got 20% of the position. It seems like what you've got then is people are trying to sell or trying to offer a put, but they're delivering a put spread because you're taking away that vol. What does a put, it's not a great analogy, but it's sort of okay, right? CTAs kind of give you a straddle-like payout because you start off at zero position, if it moves one way, you start to sell into a short, but that's what options do. But if you vol target, you've got a strangle. You've got what you're given. Just to use the short side, instead of giving someone a put, you get them a put spread because when the delta really starts going up,
you mean reverting right at the wrong time.
That's how we view it. And if you aggressively rebalance, then great. What you're supposed to do is think, I just made a fortune in an oil short. I can take some of that off if I want, if you so choose, and buy stock. Like that's what our clients kind of want to do. They want to be able to monetize that skew so their overall portfolio is better. And so again, it's a skew maximizing thing. At every juncture, if you're trying to maximize skew, generally we think you don't vol target. You have more commodities. You generally are a bit slower. That's it. That's kind of how we do it.
Dave, we're obviously interested in the systematic side of things. So what percentage of, firstly, if I can just check, with the futures trading and then also with the equities, what percentage of each of those is discretionary?
So in the MLM index, none of it's discretionary, right? It's all that's all quant. On the equity side, that's all quant. Again, it's a quant model that picks stocks, holds them for a period of time, gives them time to work. And then in the macro fund that the put says together, we trade discretionarily, and that's around about, it depends. It's sort of, generally that's a much spikier risk profile. Generally the way we structure positions is you want to risk 1% in, you've got a view of the world that's different. You think that, you think there's a drought coming and soybeans are about to go from $12 to $18, beans in the teens. What you're supposed to do then, you think, okay, I'm going to risk, I don't know, it's April, it's getting hot. You think I'm going to risk 1% of NAV on the $15 call or something. What you want is then to have a really spiky risk profile because you want tomorrow beans to be limit up 5 days in a row. You're positioned to expand delta and then become massive. So it then looks like it runs a lot of risk. Now, you've just made a lot of money, which is good. And then you can manage that by, rolling up strikes, doing something. There's some amount of position management. But generally, on that side of the portfolio, we have a real spiky risk profile. Sometimes it's kind of low, sometimes it's kind of high. At the minute, at least in that fund, it's at the higher end. We've got quite a lot of bond positions on. Running through all of it, though, we just don't sell vol. It's just...
And so on the equities side, just to put that out of the way because I want to focus on the futures, but on the equities side, what do the strategies look like there? Is that a similar trend following strategy to what you're doing on the futures side, or is it quite different?
So we have an always on portfolio because I'm American now. It's got to be long stock, and so the minimum length of stock will ever be. We're always at least 40% long stock, and the reason for that is generally the first 25% off the bottom usually happens before you know what time it is, right? It just happens so fast. You just need something on, and you just don't want to. Generally, people don't want to buy stocks. they miss it. So we always have a piece. So we break that portfolio up into some chunks. We trade US value for our sins, US growth, a low vol momentum thing that generally what we think outperforms. So we think that, and again, we actually skew maximize in that portion too. Because you think if you've got an element of a portfolio, which to us it is, you're supposed to kind of pump the ball on it. So in our value piece, we don't buy very many stocks and we equal weight them and we just let them run and we don't sector constrain them. And if that means that all oil refiners are stupid cheap coming out of the pandemic, then you know what? I own an enormous amount of oil refiners and I'm okay with that. Why?
Dave,
if that was a standalone portfolio, it'd be too volatile. But it's not. It's an element.
Dave, when we talk about so you skew maximizers, let's talk about in this equities piece. You skew maximizers there, and you're rebalancing frequently. So what you're effectively doing is it's a rotational strategy. Am I right there in that you are continually looking for the best asset strength in your equities?
Yeah, sort of, right? So if you're in 2008 or so, and stocks, you're at the end of the quarter and stocks have fallen by 25%, and you've just made a lot of money in managed futures. What we want to do is rebalance between those two and rebuy stock. So what we think managed futures, part of what they're there for is to smooth the ride. But one way they smooth the ride, a lot of people do these models, right, where they, whenever you run that model, you can throw it through an optimizer where you get monthly CTA returns, monthly stock returns. It smooths the rides. And the reason it does that, explicitly, what you're doing is you're rebalancing to set weights each time, right? So that's all we're doing. It's a similar thing there. So we just, if the CTA portfolio makes a lot of money, we resize, we reduce it some, take the gains, and then buy stock. And the other way around,
on the rebalancing premium, Dave. So our listeners can understand. If, for instance, we've got an allocation into two assets, one has done really well. When it comes to the rebalance, you're taking from the one that's done really well and allocating to another. So isn't that mean reverting into trend?
Yeah, it kind of is, yeah. In that, at the portfolio level, rebalancing does kind of do that, right? And that's okay.
Okay.
That's it. But if you're going to run all these little pieces, it makes sense to us to run them in reasonably extreme sort of ways. Like, I think generally you'd get fired pretty fast if you ran just a growth portfolio the way we do it, which is, 20 stocks, no sector constraints. We don't resize the things down. So if one of the stocks triples, sometimes you've got big positions. And we think that's okay. Would you do that in a standalone equity fund just by yourself? Well, no, because it would have tracking error and people don't like that. Now, to me, that's a feature. Other people think it's a bug. But if you're going to do pieces inside a portfolio, you're supposed to do them in reasonably extreme ways. So with the equity stuff we do is quite concentrated. It allows quite concentrated positions in stocks, in sectors, and just live with it.
So tell us the ticker of the ETF, Dave, and what's the AUM in the ETF now?
So the ticker is, it runs with a sub advisor. It runs under Crane shares, so it's KMLM. Really disappointed I didn't get the CTA ticker, but never mind. We've got KMLM as ticker, and I think there's around about $350 million in it currently. It's just over 3. I think it's 4-ish years, coming up to 4-year track record.
Nice.
And then generally we run on the institutional side. We run CTAs for all sorts of folk, generally in separate accounts.
Yeah. Okay.
I can see how you've evolved into this position, Dave, with your relationship with Linus. You probably know Art Holly as well. So
I sure do. A fantastic fellow. Yeah.
This is sort of the specialists in allocation, the specialists in portfolio allocation have come together with this approach you're talking about now, which is really sort of like it's a portfolio management approach as opposed to a trading approach to investing. And
it's kind of where it came from. And I think that it's almost a coaching tree here, right? I came from Man, and obviously I'm British, so I was based in London. And, I kind of feel like the AHL group then span out and set off some other very large managers, and generally they're in the vol targeting camp, I kind of think. Whereas there's a US kind of coaching tree, which is sort of not all the same way, but there's a lot of people came out of commodities core, right? I mean, I think Paul Tudor Jones, Bruce Kovner, Psychater, all came out of commodities cores. Tim Rodero, Matt Lucas, they came out of that, and it's kind of like there's a couple of competing coaching trees around pure trend or vol targeting, and we're firmly in the skew maximizing camp.
Well, definitely worth going back and listening to the show we did with Art Holly. It's
I did, and Linus.
Yeah,
Linus
it's a great show.
Yeah, Art's great. Yeah, I used to work with him in New York. Fantastic guy.
Nice. Rich, do you have any deeper dive questions into the strategy itself?
The only thing I can think of, I can visualize how all of these elements are clicking together to be a very powerful, sort of almost all-weather portfolio. But I'm just wondering, is there any Achilles heel in it, Dave? Like, what about the short, sharp retracements? How does it handle that?
Via rebalancing. Yeah, that is... Yeah, that's exactly right. Right. If you vol target, generally you get something of a smoother ride at the expense of generally large gains when you need them. So rebalancing deals with a chunk of it, but otherwise, we're okay with it. We think, you can see it in the US 10-year right now. The amount of times you would have been stopped out if you were faster trend following. Would have been stopped out and then reshorted the US 10-year, a number of times over the last couple of years, same in dollar yen. And sometimes, you've just got to accept, you just got to throw your hands up and you just accept the uncertainty of it.
Yeah.
And it's just, you just got to be okay with that. At some point, we think that you're better off being roughly right and robust rather than precisely wrong. We're not tinkerers. We don't optimize anything. We trade a 1-year moving average, but if someone said, hey, I really think it should be 10 months. Is that a reasonable thing to do? Sure.
Well, as you say, you're not optimizing for sharp. You're
right.
Focusing on this positive skew. And with that, there is inherent volatility to a degree within that principle, but it gives this massive lifting power to compounded wealth over the long term. So
that's exactly it. Yeah. We think it's a risk premium. I think that's the sort of think trend is we think there is a risk premium that does exist and is there, and we just pick it up. And that's this, when do CTAs generally make money? It's generally when something is, really moving. Like, so there's been a surprise somewhere, there's been an
boom equity market or bust equity market. That's where CTAs are doing really well in both occasions, long and
That's
short.
right, that's right. Like, when does the risk premium, if you're to go back to the Starbucks example, when does CTAs make a lot of money in coffee? When it moves a lot, and when the hedges that are in that market, either the long side or the short side, are prepared to pay away. That's the point of it. We're accepting that investor risk premium. And then if you're in that world, you think, it's I think of it a little like equity mean reversion. We don't trade that at all, but it's sort of an interesting area that I sort of poke around in. There's many, many ways you can do equity mean reversion. And does it really matter which way you do? Kind of day to day, but generally what you want is a robust model that captures the thing that you think exists. And we think there is an investor risk premium to be captured in managed futures, and we capture it this way. And what I don't want to do is screw that up by selling equity vol inside it, because it sort of smooths out, statistically it smooths out the return stream and helps you when trend following sort of struggles for a little bit. We're like, well, it's okay, I could have done this thing over here. We're not in the sort of the shiny toy.
Yeah, it's not the window dressing tactics. Yeah,
no, not at all.
Yeah.
You just have to accept it. You just got to, put on your big boy pants and accept it.
Speaking of the big boy loose pants, speaking of tinkering, Dave, how then has the research progressed over the years? What has changed and evolved in the thinking? What developments have taken place? Things that are happening now that weren't happening maybe 5-10 years ago? Are there things that have changed that are notable?
Some things. So, it's a great question. What we're really, really what I'm particularly paranoid about is putting in things that aren't robust and getting too far away from home. So, we added in the mid 2000s, there was a newer set of, we added global bond futures. There's been a couple of times we've changed, some contracts have gone away, some contracts have moved, went from the 10-year to the ultra 10-year, stuff like that. But generally, these are pretty small changes. It's not the same. It's the same model because it's a risk premium. And if you think it's a risk premium, I don't really want to tinker. I could do a lot of research into different ways to get trend. You could trade breakout. You could trade, moving average crossovers. You could trade exponentially weighted things. You could trade. There's all sorts of ways, and they're all fine. I'm not knocking any of them, but they all capture generally the same thing. Like everybody, maybe as of could have done this yesterday before the Bank of Japan or Japan just smashed the yen. But generally, yesterday. Doesn't matter which trend following breakout model you use to get into dollar yen. Every single person is in dollar yen because there is a large move, and it's a risk premium. We're picking that up. So the research we do is sort of balanced. We've done recent things around the way we execute. We've done research around the rolling of contracts, but what I don't want to do is do lots of research into a shiny toy that really hurts when I don't want it to really hurt.
You don't want to research into something that overfits. Avoiding overfitting, avoid the lure of sharp, and I think that's all about robustness, isn't it? It's
that's
about
right. Shiny toy syndrome.
Robustness.
Yeah, that's right. And the research we do, generally, I would put that into a different model and then have that in the macro fund rather than pollute the trend, because generally our clients do not want us polluting trend following. The cardinal sin, I think, for me, where people should fire us from the trend following side, is if suddenly, there are large trends everywhere, stocks are getting whacked, things are really moving,
and
I say, hey, I've got a strange trade in Kansas wheat and didn't work, and that costs you trend following gains. I think that's the cardinal sin. Like what you need is something robust, and don't do stupid things. These are things. So now research for the macro side. We do chunks of it. Generally I spend my time on the discretionary side, hunting for large moves where I think that the markets are priced for one state of the world, where I think that a different state of the world plays out. And there's lots of those right now. So we've got reasonably chunky positions. And that's it. We're trying to just find structures that are highly levered with low levels of, or with generally defined levels of risk. And that's it with it.
Nice. Well, it's been it's doing well, and it has been doing well for a long period of time. So congratulations on that, Dave. We've been chatting for nearly an hour, so we will start to wrap it up. How do the listeners get in touch with Mount Lucas, learn more, read the Mount Lucas blogs, or otherwise follow along on socials? Give us a few of the connection points.
We have a website, www.mtlucas.com. There's a blog on it, which is written by generally my fair hand, which is got some good pieces on it, all around skew, mainly around skew. There's a couple of pieces on there about the question we get asked a lot is, I get what you're saying. How much trend should I do? And it's a good question. Generally, the answer is more than people want to do. So it's a kind of difficult one to answer. But we ran a whole heap of optimizations on there where we absolutely torture some Clint Eastwood Dirty Harry analogies and try to introduce a concept of dirty portfolios, where you take a whole heap of traditional portfolios and then make a dirty version by, take like the, I can't remember what they're called now, but there's like the Margaritaville portfolio, right? It's like a third, something. Make a dirty Margaritaville. Again, it's a terrible analogy. But,
we'll have to put a few links up on that.
Make them dirty by putting a material allocation of trend into it. I like
That's literally what it is. And I'll send you the links. They're quite good. Yeah, we've got a blog. And on social, I've just started a Twitter or an X.
Nice.
And I think, I think that's Dave. I think it's just my name, Dave Aspell. I haven't used it yet, though. But I'll ping one of you two on it.
We'll put it in the notes. All right. Wonderful. Rich, did you have anything to wrap up with? Any other burning questions?
It's been great chatting, Dave, and hopefully we'll get you on down the track as well, maybe for specific topics, when we talk about volatility targeting or wanting a day where we come out thumping the issue. So it'd be great to get you on board with your specialist expertise there. So wonderful having you, Dave.
Yeah, thanks. I love talking macro markets, and I'd love to come back. Thank you very much for having me. It's a pleasure.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.